You see this chart? Two perfect lows. Yeah, this is exactly where I would not buy. Because when price reaches an obvious level like this, in a bullish scenario, there are three possibilities. First possibility, price respects the level and bounces. Second, it turns before it even gets there. And the third, price breaks the level. Your stop gets hit, and then it rips back above. That's the one we're talking about. So what actually happened? Think about an obvious low for a second. Everyone can see it. Traders buy around the same area, and many of them put their stops just underneath that obvious low. This is what most traders' positions will look like. So when the low breaks, those stops can become market sell orders. Think about a trader who wants to buy a large position. They need enough opposing orders to fill that position without moving price too far against them. That's why these obvious areas matter. Not because the market is hunting you, but because liquidity tends to gather where everyone is looking. Watch this. Pay attention to what happens next. Your stop gets hit, and then, boom, price explodes straight up. I'm sure you've seen this before. Price moves where you expected. And that's when you start thinking, was the market waiting for my stop? But no, we rushed the trade and became liquidity for the bigger players. If we want better trades, we need to understand what's happening around these levels. Price pushes lower, stops trigger, selling hits the market. But here's the part that matters. A break does not automatically mean the support failed. So how do you know if the break is real? You watch what happens next. Not the break itself, the reaction after the break. Okay, let's use that rule on a completely different chart. Here's the level. Two clean lows. Very obvious. Now watch this. Breaks it. Don't enter. Don't panic. Just watch the next few candles. One candle stays below, then another. Price keeps trading under the level. We wait for a few candles and see if the level really breaks with strength. If it breaks hard and stays below, we can wait for a pullback and look for good short entries. But if price quickly comes back and forms a V-shape, there's a good chance the stops were triggered and price is ready to move back up. To confirm the move, we want to see a fast reclaim or a very strong move down. If price doesn't come back quickly, check the higher time frame too. You might find that what looked like a real break was actually just a wick on the higher time frame. That's the one we're talking about. So what actually happened? Think about an obvious low for a second. Everyone can see it. Traders buy around the same area, and many of them put their stops just underneath that obvious low. So when the low breaks, those stops can become market sell orders. Price pushes lower, stops trigger, selling hits the market. But here's the part that matters. A break does not automatically mean the support failed. So how do you know if the break is real? You watch what happens next, not the break itself, the reaction after the break. Now watch this one. Same idea, same obvious level. Price breaks below it and suddenly snaps back above. There it is. The level has been reclaimed. The break didn't hold. And that's the information we were waiting for. But there's one thing I really don't want you to do. Don't look at every wick and scream, "Stop hunt." No, a wick is not proof of manipulation. You don't know exactly why price reversed, and you don't need to. What matters is much simpler. Did price accept the break or reclaim the level? Now you have a setup. And this changes one thing completely. You stop asking, why did the market hunt my stop? And you start asking, why was that level so obvious? Then what happened after everyone reacted? Because sometimes your direction wasn't wrong. Analysis wasn't wrong. Your timing was, save this before your next trading session. And next time you see two perfect lows, don't rush in. Watch what happens after the break.